Welcome to the Dividend Talk podcast, episode 146. Quarter one earning results for some popular dividend stocks. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. How was your week off podcasting?
Well, first of all, of course, apologies to our listeners. We really couldn't make it last weekend. We put it on Facebook and on Twitter. Just life took over, right? I had a business trip, really busy weekend as well, and my something private going on. And we just couldn't meet. And you were also in a different time zone. So this was one of those maybe once a year occurrences that it happens that we just simply can't find even an hour time to hop on a call and record the podcast. But I'm really happy to be back because it really felt awkward not having a podcast. I didn't know what to do with it. We really felt guilty. I remember that as well last week. We just couldn't connect.
We did try our best, but as you said, life got in the way. I also had a business trip, and 5 hours time zone difference does make a big difference because obviously sleeping and waking up, and we're working different schedules as well. So it was difficult. But hey, we're back. We might try and plan a little bit better in the future around a couple of episodes if we do happen to be away like that. But I'm just glad to be back this week because it's been a crazy week, straight back into earnings.
Yeah, and I had to really catch up this week, like yesterday and today on the earnings, because I even didn't check almost my social media last 2 weeks. I didn't really check any news around my holdings or anything. So I was totally blank, let's say still by Wednesday evening. But yesterday evening I started catching up, and I mean, there was some really good stuff in there, right, with this earnings. I mean, they talk about inflation everywhere, but you only feel it in your wallet, but not in your portfolio. It's so amazing to be an investor.
Yeah, it's a great time. But I mean, what's funny is we've been off for now a week or so. It's probably 2 weeks since we spoke, but some things never change. Small banks are still in trouble.
Yeah, have you heard that? First Bank Corp, I believe, going bust. JP Morgan buying it. Now some other banks being hammered on the stock exchange, the small banks. And I remember Powell saying and others saying after the first Silicon Valley Bank, like, no, this is all contained and, don't worry. And second bank, now the third bank. I mean, it is a dominoes in slow motion. And honestly, when you look back at 2007, 2008, it also took half a year to play out. Yeah, when the first trouble. I think we discussed on it a few shows, and I don't trust these wankers with all their predictions. I think they have an incentive to keep the market calm, not to panic. But I think in the back rooms, back office, they're really, really scared with what's happening. And of course, every crisis is different. But this one rhymes a little bit when you look at this, and it can at a certain moment easily spill over, right? We don't know, might nothing happen, but I don't trust what they are saying. If I see these banks being in trouble all the time, I just don't buy it, not at all.
No, not in a million years. But also, what's coming out of it is there's a lot of insider trading that's been reported. There's guys selling these banks before they.
Yeah,
just before they collapse, and then they're buying bigger banks that are going to bail out these banks. It's just crazy what's going on at the moment, and the market doesn't seem to be reacting as strongly as I thought, to be fair. It is uncertain. We are a little bit choppy, but I expected it a little bit more to be more sea of red lately. I look at my portfolio, I just don't see that. Obviously I see some red, but not as much as I thought. So it's still still early days, as you said. It can take maybe 6 months to a year for these to play out, but it's just good to sit back and watch what's going on, because I don't own any banks, and thank God I don't.
Yes, yes. And by the way, I got the T-shirt, Bankers are Wankers. So I have it now, and I will proudly wear it on the next occasion, maybe when we're online on a call with Dividend Day. Or, and this may be a little bit of an, I would say, the heads up, in June, I believe around the 24th of June, some of us want to meet in Frankfurt to just discuss about dividend investing. Thiago, who was here on the show, is also part of the organization there. Alan will come over. So if you're listening to this and you're interested, we'll create a Facebook event as well. You can sign up there via the Facebook group. Then I have no clue how many people want to join. We're just few lads that want to meet, talk about dividends. So if you're interested and you so happen to be in the neighborhood or want to hop by, feel free to join. And yeah, there will be a Facebook event created so that we can all plan accordingly as well.
Yeah, awesome. I recommend everyone hopping on that. I can't go. I'm in Turkey on a family vacation, but it should be quite good. Frankfurt is such a good place as well. So
I think so. I wanted to just buy 10 eggs and go to the ECB.
exactly.
Good.
So other news we have this week: Warner Brothers Discovery lost a total of 1.1 billion this quarter. That is a lot of money.
Yeah, I mean, I don't consider this anymore a dividend stock, right, as such. But you know, this all with AT&T and everything. Remember the whole saga? I believe you just sold your shares not too long ago, right, in AT&T.
Yeah.
And if you just think about John Stinky, what he was all selling at the time, like, oh, Warner Brothers, and you know, it's better on its own, merging with Discovery, and we cut the dividend because, you know, also for them. And here you come, 1.1 billion loss. And not just Warner Bros. Discovery, it's also the other streaming services. It comes with so many investments that these companies are not able at the moment to make a profit. And if you think back about John Stinky and how he's managing and that he's still at the helm, it just, I don't understand it. And the other day I got a question about, like, you know, maybe at the current yield and the current valuation, AT&T is actually a nice opportunity. I mean, what confidence does it give you that AT&T is now a value stock? Because that's what we're talking about then, right? I mean, what a stuff is going on there. It's unbelievable, right? If you look at this also a bit in hindsight.
Yeah, I mean, I think you're dead right. I did sell them. I know HBO, well, the company behind Warner Bros. HBO, they're struggling, aren't they, to transition from like your classical TV channel to an online streaming service where they're up against the likes of Netflix and Disney. So they're under a lot of pressure here, and it probably was the right thing to do for AT&T to spin this company off. Because if this happened under their stewardship at the moment, you would definitely see a bigger reaction. But in terms of AT&T being a value play, like you said, I've lost all confidence in them. They've got too much depth, and it's hard to see where the growth is. The dividend yield, it's quite high there again, but we've been there before and they've cut that. So I don't know how safe that is. So for me, I would stay away. I am staying away from AT&T. I much prefer Verizon if I was to pick one of the two. But I also mentioned the company CCOI, Cognic Communications, who I would prefer over both of those companies.
Yes, and then you still have Orange in Europe, which is more like a high yield play, as you mentioned before. Do you own some of Orange, right?
Yes, I own Orange, but again, Orange is something similar. They are high yield, but they are prone to cutting that dividend as well. So it's not a long term play. It's a high yield play for a short amount of time. As soon as I get a sniff that they are starting to struggle or change, particularly in France, then I'm out the gap. I'm out. I'm selling.
Yeah. So and then maybe the last news here is that Johnson & Johnson finally IPO'd Kenvue on the stock market. So it IPO'd at $22 per share, but I believe it's now already trading at $26 after 2 days. Johnson & Johnson will still own 91% of the total outstanding shares. So also we own still a lot, but What is not clear to me, and I really don't get a clear answer on this, is if we as shareholders get some shares as well. I saw on Facebook where Alex also asked these questions. I saw someone responding that, yeah, if I'm correct, right, if I remember correctly, that we should own something, but I just can't find it anywhere. So, yeah, I don't know.
Yeah, it's a wait and see. I've seen some mixed reports. I've seen some people say we'll get him at the end of the year. Some people say we'll get him sooner. Some people say we're not getting him at all. I'm none the wiser. But it's look, it's interesting to see that it has IPO'd. It's done quite well, but it's still early days. That could change. There's a lot of euphoria in the market. So let's just wait and see. But I'm waiting patiently for my shares as well.
Yeah. What will you do with them if we will get some? Would you sell them or keep them?
I'm probably going to sell them. I'm probably going to sell them.
And why?
I mean, we talk about the consumer health. The consumer side of Johnson Johnson was slow growing. I'm still unsure what their dividend policy is going to be. Will it be growing? So, for me, it's probably going to be like Warner Brothers when I had AT&T. I'll just sell them and move on. Keep Johnson Johnson and sell the spin-off. You're going to keep them, I assume, are you?
No, I'm not interested in them. I studied the shares or the consumer health business. It was like flat growing for almost a decade. Now it made some gains again, but for me, I see it as a struggling business. So I'm not so much interested in it. I have already Unilever. So yeah.
Cool. Some dividend hikes this week. We've had a couple. Leggett and Platt, ticker symbol LEG, hikes their dividend by 4.5%, which is not too bad. I mentioned CCOI, Cognet Communications. They have hiked their dividend by 1.1% this quarter. That's the 43rd consecutive quarterly increase, and it gives you a year-on-year increase of just over 9%. I think it's 9.35%, which is quite nice.
That's a nice pick of yours.
You do not see that from AT&T, let me assure you. Simon Property Group hikes dividend by 2.8% to $185 per quarterly share. PepsiCo have declared a dividend. I think we've said this on the show before, but they have raised their dividend by 10%. It is now obviously official, and the quarterly dividend stands at 1.265%. And I know you're happy about this last one. Apple, ticker symbol APPL, hikes their dividend by 4%.
Well, happy is not the right word. I would have expected like a 10% hike with all those buybacks. Yes, so I understand they want to keep the payout ratio low, but for me, 4%, come on, for such a growth company, growth story. I mean, Uncle Warren is getting a fat paycheck every time. I think he gets like 15 or 20 times more than Warren Buffett. Yeah, he gets like 20 times more than Tim Cook in pay when there's a dividend payment. But still, come on, 4% for such a company in growth. It was a bit disappointing, I must say.
The way I look at it, 4% dividend growth from a non-dividend company, because I don't consider them a dividend growth company.
So I do. They have a decent track record now, and I don't see a reason why they would stop growing. Once maybe the high growth is over, they will claim like, oh, we do shareholder distribution in the form of dividends, and because companies go in seasons, right? You go from growth into more value and such, and Apple will reach that stage today, and then they can say already that they have already 20 years of dividend growth and how committed they are. So I think they're not stupid, specifically not Tim Cook. So 4%, come on, guys, could have been a bit more. Like give me less buybacks and give me a bit more dividend yield, I would say.
That's a fair assessment or a fair ask of them. Maybe write Tim a letter and see what he says.
Oh, I will try to do that. Or I go to the gym there in Silicon Valley and try to catch him and have a word with him.
Yeah, that might do. Just don't get him fired. He's doing a good job.
So far, yes. Yeah, but he should not do this another time, because then we have another conversation with him.
Okay, earnings. We have quite a few to get through. I think we have 6 or 7 on our list from both Europe and the US of A. Maybe you might want to start with one
Well,
more.
I just have to start with the best of the best, the king of kings, and with the best credit rating in the world, Microsoft. I know I sound like a broken record, but I think it's important to continue repeating this every quarter because these guys are really on fire. Their revenue grew with 10%. And what is important here to know, companies generally, we see it everywhere, they are cutting costs. They are firing labor force, the workforce. They are effectively closing the doors. They are trying to save money everywhere. Also in the industry where I'm working, this is currently the trend. They are still able to increase their revenues 10% year over year. For me, this is mind-blowing, really mind-blowing. Income, therefore net income, increased by 14% constant currency. Yeah, and it was currently standing at 18.3 billion, which gives it a diluted earnings per share currently of almost $2.50. So if you would extrapolate this to how you say it, to a year, you're talking about $10 in earnings, and that gives it a 31 or 32 PE now. What just keeps surprising me is the growth of Azure. Azure and other cloud services revenue grew 31% constant currency. The intelligent cloud division that this is part of is currently making 22.1 billion in a single quarter effectively. Now, what is visible here as well is that Windows OEM revenue decreased with 28% and device revenue 30%. Think about Surface. This is what we see across the industry, right, with personal devices and everything, and that's what this is really affected by. But also, even I just wanted to highlight what I really liked here as well is that search and news advertising revenue increased 13% constant currency. And I know that the trick that they did with Bing and OpenAI is really contributing here. And for me, this is really the story. And you know what is nice about such a SaaS business that Microsoft turned into? Almost all their additional revenue turns into incremental profit because the revenue grows quicker than the cost here. Yes, so and the incremental costs, the costs are really fixed. Yes, with low incremental costs, which means that also now their gross margin grew to almost 70% from 67%, yeah, year over year. And before you know it, these guys will be at 75 or 80%, and you are talking about Visa kind of gross margins here, simply because they have a certain fixed cost base which grows a little bit with every customer, but the revenue increases much more. And this is what I like about these businesses that can scale at almost no cost. And that's really the benefit of Microsoft currently being a SaaS business. Look, even here, almost 18 billion in free cash flow, right, in the last quarter. 5.5 billion in buybacks and 5.1 billion in dividends. So still they were able to pay down 6 billion in debt that they have, because they have some debt nowadays on the balance sheet. But what was also interesting, like, look, they have been buying back a lot of shares, approximately around 20 billion or so in the last 12 months. But this only, think about these numbers, right? This only affected 1% of the share count. So they reduced their share count by 1%. And why? They have a market cap of 2.3 trillion at the moment. So yeah, buying back at, let's say, PE of between 25 and 33 is really expensive. And in my opinion, I know that Microsoft doesn't know what to do with their cash in generally, so that's why they are just buying back. But why don't you give a special dividends then? Because I would reinvest it in companies with PE below 20 and maybe around 15 with a higher dividend yield. So I believe as an investor, I think I would make other investment decisions. I would not invest it in there back into Microsoft at these PEs, and I rather would buy, I don't know, Johnson & Johnson at the current price for this. So I believe that Microsoft should give us either special dividends if they want to, if they have too much cash, or they should just bump up the dividend by 50 to 100% next time.
Yeah, I agree. I was going to ask you that question around dividends or special dividends. I think it makes more sense rather than buying back this company at a 33 PE or anything anything that high. So it would be nice
Yeah,
of them to.
because it's meaningless almost, a share count reduction. I mean, yes, year over year, maybe after 10 years, you talk about 10%, but at these valuations, I'm really more in the camp of Warren Buffett. Like, you shouldn't just automate the buybacks like this. I know Apple is doing it as well. You just heard my comment here. I've give me the money and I'll invest it in some nice dividend growers.
Yeah, yeah, I agree. But overall, it was a strong quarter, and you didn't even mention LinkedIn. I always, I mean, I can't believe how strong they can grow LinkedIn. I think 10% year over year, and you look at the likes of Twitter are struggling to
Yeah,
to make money. It just shows the management how well that they
and
can.
10% year over year. Well, while also the job market is shrinking, specifically also in technology and IT. Yeah.
Yeah, yeah. Awesome. Okay, I might talk a little bit about T Rowe Price. I know we both have them in our portfolios. I was buying them quite aggressively towards the end of last year and the start of this year. And I don't think it was a surprise that they are struggling in the current market. You can see that their net revenues is down 17.5%, operating income is down nearly 50%, and net income is also down 25.8%. But one thing I did notice is that their assets under management, which is what all good asset management companies are judged on, actually increased by 67 billion and now stands at a whopping 1.34 trillion. I think they actually did better than most people expected compared to the consensus. I don't pay too much attention to that, to be fair, but I think overall it's still been a solid showing from them. They are struggling with investments. The current inflationary environment is hurting them, but they've got lots of dry powder, as they say. Net cash inflows was down about 16 billion, but overall it's been quite strong for them. And look, they've got a really strong balance sheet. I think that's the key to T. Rowe Price above all other asset management companies. It's that balance sheet is strong and can withstand that. So quite happy overall. To be fair, I was expecting it to be a little bit worse, and I definitely was not expecting assets under management to grow, but it's a nice little growth spurt from last year.
Yeah, what I also like is that the dividend is still nicely covered, right? So you pay now probably 75% payout ratio. And I mean, this company is just doing really well. The share price dropped, I believe, by 5% or something like that after the earnings. So I started looking at it again. Should I buy some more or not? Because this company is just effectively doing what it's saying that it will be doing. Pristine balance sheet. I mean, these are the opportunities, right? These are the opportunities. I own already quite some now, and I should hold myself a little bit to buy too much. But it's very, very attractive for me because also the I look at it from a risk reward point of view, and if you then see the yield that you get right now, I think it's just at the really good stage to consider.
Yeah, I was always buying them when they dropped a little bit under 110, which I think they are now. But I believe they're gone nearly top 5 in my portfolio, so I have to try and pull
Yeah,
back. But I mean, 37 years, consecutive years as well for dividend growth, and that balance sheet is really what stands these out. And I think these are the times to buy this type of company when they're struggling, when
yeah,
everybody is waiting for them to to fall down and go away. But I mean, assets under management don't lie. There's a lot of
yeah.
people, a lot of investors with a lot of money trusting T. Rowe Price, and
Yeah,
I,
and of course, also the share price went down, I think, because of all those banks struggling, and they are part of the financial sector. So there's a lot of index fund investing going on, and if people are selling their financial index funds, yeah, they are also selling T. Rowe Price with that. So there's also pricing pressure from there. There's, of course, we just mentioned in the beginning of the show that we don't really trust that this is the end with the news about banks. So also, I don't think we have seen a real crash yet. So while it's trading now maybe around 207, in a real crash, yeah, like another 20% down, this company can easily trade still at 70 or 80 dollars. Yeah, so that's also the risk here. At the same time, but still they can weather such a storm for even 2-3 years without touching the dividend. Of course, sentiment will change, pressure will change, and such things, but that applies to all companies at that moment in time.
A 20% deduction in price, if they're trading at $80, I'm buying more. I don't care if they're top 4 or top 5. I'm buying more.
It's always easy to say, my friend, but when this is happening, many other stocks are at a discount, and maybe the numbers look really ugly back then. And I've seen too often that people are buying stuff, let's say, at a certain price, and then it drops 20-30%. Then they are like thinking like, I'm not sure. I want to sit it out. I want to wait. I want to, yeah. So
we'll see. We'll see what happens to the market, but I definitely would be interested at that price.
Yeah, same here. Yeah, good. So I want to discuss and pay some respect to a stock that we hardly ever discuss here. This stock I have had so much on my radar, specifically in my early days of dividend growth investing, because it pops up on every initial screener when you do it. And this is Emerson Electric. So I still don't own this puppy, and I sometimes wonder why, because I could have easily bought it at really nice, attractive valuations. So for the people that don't know Emerson Electric, they are typically a manufacturer of products and services in the engineering space. So think about everything related to automation, and actually your field of expertise, I would say, and mostly in the oil and gas and energy industry.
Yeah.
They have also now quite a significant of IT software business there. I believe after one of the recent acquisitions, it stands probably almost at 15% of their sales. But what is so special about this is that it is a dividend king with 66 years of consecutive dividend growth. So it has survived, for instance, the 2016 oil and gas crisis, which Shell forced to cut their dividend. Emerson Electric is a company that is actually usually more sensitive to this, because if capex is stopping at ExxonMobil and everything, then Emerson is feeling the impact twice as hard. So that's what it makes it even more appreciative that they have this track record for 66 years. Though I must say that the dividend growth in recent years has been very slow. I think in 2018 it was like 48.5 cents or 49 cents, and now I think the dividend per quarter stands at 52 cents. They only hiked the quarterly dividend with half a cent last time. And it is really doing this to prepare itself again for the future, also to give it some wiggle room. They're really pivoting their portfolio. They're doing quite some divestitures and acquisitions. Effectively, they're restructuring their portfolio and higher margin businesses, let's say, and products. And it's doing this actually quite well. So I appreciate here again that they continue paying their dividend. They're loyal to the dividend, but they are also honest to shareholders, saying like, we need this time at the moment to re-strategize, reshuffle our portfolios, that we are set up for the future again. With that, also their payout ratio is really nice now, depending on the earnings from last year, around 40%, on now the forecast rather about 50%. And that's also maybe where I want to jump a little bit in the earnings, because first of all, what's really important for a company like this is the orders, the order book, and that has been growing with 7% compared to the same time last year. Sales has grown compared to last year 14%, so that's good. That means that also the big oil and gas companies are investing again properly. The capex is flowing to these kinds of companies. They have a earnings per share at the moment, GAAP based, of 92 cents per share, which is, as I mentioned, easily covering the dividend. It was also a 28% growth year over year, and their free cash flow currently stands at 513 million for this quarter, which also allows them to easily pay the dividend. Now, this is where it comes nicely to the outlook as well. They expect a sales growth for the entire year around 10 to 12%. Earnings per share about something about $4 at a current share price of 84. It is therefore trading around, let's say, a 20 PE. You will see if you go to Google that it says like a 10 or 11 PE. Please don't be mistaken by that. It's a 20 PE. I find that too much for such a company at this moment in time, which is also cyclical and going towards the higher end of the cycle. I believe, therefore, that it's not attractive for me now, but it is a company that I really want to have on my radar and my watch list, because I would like to consider buying it next time when it becomes available again. And currently it's yielding 2.46%. So hence also not meeting my criteria. But let's say if it starts touching 3.5%, so that would mean like trading at around $60. I think that is possible to see this company trading there again in the next 2 years if something happens in the oil and gas industry or with the oil price. I have it on my watch list, my long-term watch list, and I feel I just need it as, for instance, a tier 4 stock in my portfolio.
Yeah, it's a nice company. I know they're heavily involved in oil and gas, but I think they're also branched out into water, wastewater, food and beverages, and even not as much, but maybe life sciences. I'm not in any of those industries, so I don't particularly use many of their products. And they're also based in the US, and we have different rules and regulations over here in Europe. But I am aware of the company. I more understood them from an electrical control point of view. I know they do components, lighting, and so on. But I was just browsing through the website there while you were chatting. They do some nice things, particularly in around augmented reality, automation, which they're really starting to go down, which is quite good, quite novel to see. But interesting company, one that I would probably put on my radar. I know I have a few companies in that field, someone like Cognex as well that do cameras and vision systems. But interesting company, and I think if they can really pivot and really push this AI and IoT services that they're trying to do, there's some good growth there for them.
Yep.
Nice company. I'm going to switch gears a little bit as well and talk about a company. I think we spoke about them once on this show. We picked companies we might like to own, and Ferrari, ticker symbol RACE, was on that list. Really nice company. They've have an okay dividend history as well, and I thought it would be actually quite cool to look at their earnings. And I have to say it was quite strong from them this quarter. Their revenues grew by around 20% to 1.4 billion. Shipments have also gone up 9.7%. Adjusted EBITDA was positive 27%. But their free cash flow was down about 9%. But that's over the quarter. Over the whole year, that more than covers their dividend. They've also announced a dividend of €1.81 as well. What I do like about these guys is that the results in Formula One actually contribute to how well they do in their financial terms. Obviously, sponsorship and all those good perks that come with winning enhance revenues and so on. So it's quite interesting. I know Ferrari got off to a bad start, and they called that out in their quarterly report as well. Mixed results in Formula One, they call it, but they seem to be back on track. I watched it last week. Did you watch it last week?
Yes, of course.
They seem to be back on track, so maybe we'll see in Miami they might push a little bit forward. But it's look, a really good quarter from these guys. I think they have potential to be a good European dividend payer. They've cut it once back in 2020, but it does look like since 2015 it is on an upward trajectory. So it's a company high on my watch list. It just seems a little bit expensive, trading at a forward PE ratio of 40.4, which is a little bit high, but
Nice.
It's a company I would love to own just for the brand name. Everybody wants a Ferrari. Maybe I just
So yeah, that was my question that I want to ask you. If you could buy one sports car and you would have, let's say, the budget for those, would you buy a Ferrari?
Oh, I would, yeah. I think every kid has dreamed.
Why not a Lamborghini?
I mean, I grew up watching Formula One as well, and you don't have Lamborghinis in Formula One. Ferrari was always the pinnacle. Everybody wanted to
Yeah.
own a red Ferrari. Not any other color, has to be a red Ferrari.
Yeah, with such a horse.
Yes, exactly.
Yeah,
Yeah.
yeah. But not
But
with my wife in it. It will be just for me and my friends.
one seat, two-seater then. But
Yeah, for me and my son.
yeah, no, a decent quarter from these guys, and I wish they were trading a little bit cheaper than what they are. The dividend is, as I said, well covered, but the yield is still quite low. It's 0.61%. So we need the share price to drop significantly. But overall, good company, good brand, and on my watch list.
So let's then quickly jump to Ferrari's main co-sponsor, the logo you see on every Ferrari, and that's the big yellow shell. And here it is my top holding. So Microsoft is my second largest position that I mentioned. Shell's my first largest, just my largest. And again, right, a free cash flow of 10 billion in a single quarter. We were just talking about Microsoft doing, what was it, 18 billion or something like that. Shell is not too far behind with the big boys, I would say. 10 billion free cash flow. They are announcing also again share buybacks of 4 billion in just the upcoming quarter. I'm talking about 3 months. That's a lot of money. Their earnings were again really good. They reduced debt a little bit, so the net debt is now 44.2 billion. I think they could have done a little bit more, but they are full in the buyback mode now. The reason for that is actually also simple. They have their targets around gearing. They're really nicely on that one. So I feel that management doesn't feel they need to, reduce it more, but they can use it more for acquisitions and in the new energy space, for instance, and then also for buybacks. But I love more I like more, for instance, ExxonMobil's balance sheet, and I believe, why don't they just try to bring it back to zero? Yeah, as a principle, why not be debt free if you have all this cash coming in? On the other end, I just did some math here. Did you know that Shell over the last 12 months reduced the share count with 9%? 9% in 12 months. Yeah, so the money is really, really flowing back.
That is a lot of money. A lot of money.
Yeah. And in 2016, they really increased their share count a lot by buying British Gas at the time, but also with the scrip dividend. Now, this with the scrip dividend, I still need to finish my overview, but I believe they have it all already largely bought back, let's say. Of course, at higher prices as well, mainly. But at the moment, the buybacks, they are so effective because this 4 billion that we're talking about is another 2% share count reduction. And that means like where we could say in the past, for instance, I don't know, the bottom is at 20, and when it's goes through that bottom, it's like really like zero oil price, let's say. But 20, that over time becomes 22 and 23 and 24, right? With all these buybacks. So this is really nice to see. And here I'm supportive to the buybacks because it makes sense. Yeah, this is not a high valued company as such, not even at peak earnings. So for me, buying back at these prices makes horse sense, and you can see the impact of it, right? And it's out of free cash flow. They are not increasing debt or anything. It's just cash, pure cash that comes back to the shareholders in the form of buybacks.
Yeah, but I'm with you. I still would prefer them to clean up that balance sheet a little bit more. We know that they are cash rich at the moment. We're in the good times.
Yeah.
I think that's the time to clean up that balance sheet because we will go through the bad times and that balance sheet will have to get worse again. And I would prefer it to be a little bit better than what it is. I mean, 44 billion, they could have easily had that down to around 35 billion at the moment.
Yeah.
Easily.
Well, management thinks different. They think with a gearing of 30%, let it rise to 40% in bad times. Yeah, because what they do, they will slash capex in those times. So they feel comfortable about this. But why not take just the approach as zero price and knowing you're cyclical and just say we go for zero debt? I mean, debt to equity looks good, right? I think when you talk about long-term debt is about 70, 80 billion plus 95 billion equity. So that's really a strong, like definitely a very solid A-rated or double A-rated balance sheet. And maybe the CFO says like, cash is trash or something like that, right? We can better buy it back. I don't know. What's wrong with having no debt on your balance sheet, right? Nothing.
Yeah. I would prefer to see nothing on the balance sheet, but look, we can't complain. They've given us some really good returns. I know they cut that dividend, but since that, the amount of buybacks they've done, they've increased the dividend nearly every quarter as well. It's been quite good to us, I have to say, since 2020. So it's just a little thing I would like to see, but as you said, management have done such a good job. It's hard to fault them as well.
Yeah, and what is maybe also really good to call out, I almost forgot to mention that it's not your oil company anymore. So when your family complains owning Shell that you're damaging the world because of black oil, I mean, at least from an earnings point of view, did you know that integrated gas made 4.9 billion in earnings in the last quarter and upstream? And this is where we talk mostly about oil, 2.8 billion. Yeah, and in the cash flow, it looks a little bit more towards each other. But it's more a gas company at the moment than oil, and I think many people still don't recognize it like that. But the British Gas acquisition was such a smart move from Shell to go into the transition, and you see it in the numbers back.
Yeah, great timing, great move by them. So, and as you said, it's interesting. They are a gas company, but there is no way you'll be able to convince everybody Shell is a gas company. No way.
Yeah, exactly.
Okay, I'll quickly move on and talk about Novo-Nordisk. European companies tend to do a sales update rather than a full earnings update. And you know what? Sometimes I actually prefer that. You don't have to go through all the garbage to give you a little indication of how they're going. Novo-Nordisk, as we said, is such a strong European company. Are they the second largest by market cap, I think we said last time? And look at these sales numbers that they've just posted. Operating profit increased 31%. Sales in North America increased by 47%. I'm not surprised. Sales in diabetes and obesity care increased 33%. Obesity care on its own grew 131%. That's just absolutely phenomenal growth. They're still working away on R&D. They have three new drugs in phase 3, and they've also increased their expected growth this year to be 24 to 30%. I mean, that's incredible numbers, isn't it? But I'm not surprised. I'm not really surprised. We know diabetes and obesity is a huge problem, but these guys are capitalizing on it. And I think they've actually increased their market share again by about 3% as well. So strong numbers from a strong company.
This company is on fire, and actually also I believe yesterday or today they announced that they are limiting their Wegovy doses for new patients because demand is outpacing supply. Yeah, so these are these injections that actually also, well, it helps celebrities losing weight. Yeah, so it became so popular in the US, not just for, let's say diabetes, but also just for beauty.
Yeah.
That they're struggling with the supply at the moment. Now, I don't know if that's a good sign because at a certain moment can fire back. What I'm afraid always with these is if people are using it, let's say off script, like not for diabetes but for beauty. We had an opioid crisis with Johnson & Johnson where they stimulated the sales here, where half the youth was addicted in some areas. You never know what the fallout of this can be for Novo-Nordisk. So if I was the company, I would try to do everything against healthy people using this just to lose some weight as being a celebrity or whatever it is, because you really don't know what the long-term effects of these are here, and because it has been tested probably on diabetes patients. Yeah, and for that they got granted an approval. So for me, this is always really risky here. Maybe it catches over to the youth later as well. I find this risky.
Would 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 that be Novo-Nordisk's responsibility? Do they not sell their drugs to like the pharmacies and the wholesalers, and then the wholesalers distribute them? Like, would they have control over who the end user is? I'm not sure. I don't know.
We are talking now about ethics.
Yeah.
Yeah, it
I
doesn't really matter who the distributor is. You're still the producer, and you decide who gets to sell your drugs. Yeah.
Yeah, but in terms of litigation and coming back on them, if they don't control who they sell, who it's sold to, I don't know how the litigation will come back.
Yeah, but this happened also to Johnson Johnson. But then it comes to the incentives you give to doctors to prescribe the drugs and such, right? And there is really something where companies have an responsibility, a corporate responsibility here, and this can still look weak in a courtroom, and specifically when you have a jury system. Yeah, so I mean I know it's probably a low risk, but when I read these kind of things, I always get these feelings, guys. Let's stick to the drugs what is intended for, yeah, and not use it for these kinds of things, because you don't want to have like 10 years later down the road 20 or 30 billions in fines because half woke Los Angeles was walking around with a needle in their neck to loosen half a kilo. I mean, what's wrong with an apple diet that the model said like 20 years ago?
Yeah, yeah. I was just kind of curious there to see, would they have control over that. I get it's a question of ethics, but I was just curious to see how it would come back on them. But as you said, they're probably selling it, and I'm sure it says it on it that it's for diabetes and that. So we'll see. I don't know how they could control that. I really don't.
Yeah. Yeah. Anyway, awesome company. I mean, together with ASML, L'Oreal, I think really the top three companies on fire in Europe at the moment.
Yeah. Awesome. Okay, we move on to some listeners' questions. I know we have quite a few to get through. We'll start with Martin, and he has asked us, have we ever taken a look at Nintendo?
Oh yes, definitely, definitely. I mean, I'm from the 90s when I grew up as a teenager. I mean, I had most of the consoles of the whole lineup, so I've got so much memory around Nintendo that it's really a cult stock for me even to consider. What Martin also says that it's not really a dividend growth name. I agree with that, but he's mentioning that there's a solid yield and a strong balance sheet. That's true. I also agree that it has the potential to grow dividends for years to come, but my issue with Nintendo is that Nintendo is really depending on technology and innovation power, and they have had really tough times over the years, because if they have a miss somewhere, it can go really quickly, right, to the wrong direction. They have been all the time innovative, but we don't know whether the company is able to keep up this pace over the next 5 years. And as it is so depending on product development, I in such a competitive market, and for instance, the investments that Xbox is currently doing and also streaming and everything, I have not gone deep enough into Nintendo, but knowing that it's so sensitive to consumer trends as well, it's not for me an investable company, and it stays rather like a passion for Nintendo. I mean, they will sell Mario still for the next 10 years or 15 years, but it is either for the masses or for the cult figures and the people with the sweet memories like myself. And I would not be in big enough market for Nintendo to continue paying growing dividends.
Exactly. Yeah, I'm similar to you. Obviously, I grew up with the Super Nintendos and Nintendos and Mario Karts. But I always struggle to see them. You compare them to the Xbox and to the Sony PlayStation, and I just feel like they are both ahead in terms of product development and probably user base as well. I know you've got the Switch and you've got the Nintendo Wii, and you'll always have like a Game Boy you feel, but I just look around the generation beneath me and I don't see them on those devices. I really don't.
I see them enough. I see them enough around me. I also see a lot of adults in the airplane with a Switch, and they don't need to be the number one player. Yeah, I think they're totally fine with being the number three, and there's still enough market for them there. But I'm more looking at it from like they went from Nintendo 64 to GameCube, and GameCube was just a fiasco compared
Stop.
to the hit of Nintendo 64. And this latest Switch is also a big hit for Nintendo. It really also got a new user base again, more younger kids again. But it's always about what's the next console going to bring. Yeah, with these, and that's where the cyclicality, I guess, comes into the business, and the risk is in the business. And for me, that's not a good enough business model to own a stock like Nintendo, unless you look at it from a value play point of view. But then you really need to be in it as a value investor rather than a dividend growth investor.
Trip has asked us how our vacations were. Not really a vacation, mainly work. I did get some time to go down to New York to see my sister, a short trip, but pretty much a work trip. And I have another one planned in 2 weeks' time again in the States. So I'm going to be racking up these miles over the next couple of months, I reckon.
Same here. I mean, it was work. So I wish it was a vacation.
Yeah, exactly. Alan has asked us a big question for Alan. This is, what do you do when you reach fire? He hasn't been able to answer this question yet.
So, I mean, I can't answer the question indefinitely, or how you say it, but there are a few options. I can see myself continue to work as long as I like my job like I do now. I could see myself working part-time at the job where I'm now. I could see myself quitting my job and doing maybe more of blogging and everything. But I can't see myself do nothing. I can't see myself traveling really a lot. I'm stuck from that point of view with my kids. They are more important that they have a stable environment to grow up. So I can see myself traveling when they are out of house and living maybe in another country. But I will always be busy with something. And yeah, that's how I look at it. And I'll see it when I reach that time.
Yeah, I agree with Alan. It is a really hard question. You have all these ideas of traveling the world and all this, but realistically, as you said, kids, family, there's always stuff going on. Personally, I would probably not work the amount of hours I'm working now because it's a lot of hours that I have to work. I would think about opening up a coffee. I had a coffee shop before, remember, but I would think about opening up like one of those kiosk ones where you work 4 or 5 hours a day and then that's it, and you really just there to chat to people and see how their day was and pour coffee. But yeah, like you, I'd have to work. I'd have to do something. You need to keep the mind going, ticking over. Otherwise, you would go mental. But yeah, it's a very, very hard question and one I don't think anyone will be able to answer until they get to that stage.
Yeah. But the nice prospect is like if you're seeking more purpose in how you spend your time, yeah, that's the ideal moment. Yeah, I'm also thinking, for instance, I work in the IT sector. I wouldn't mind still just teaching kids about IT, yeah, specifically the underserved, so that they get better chances in the job market. And that's the nice thing about this, right? That you can really use your skills then, but you don't need to get paid for those skills, which can give you a new purpose, let's say, in life. And I think that's really nice that you can later look back at your life and say, like, I didn't only earn money and made the rich richer. I actually also improved the environment around me, the local community around me, or something like that.
Yeah, giving back, I think, is definitely something everybody should try and do.
Yeah.
Okay. This has asked us, what is happening to Teleperformance?
Yeah, so I tried to look it up, Thijs. I know they reported their earnings, which looked actually quite good. Also, the forecast looked relatively good. But I just can't find it anymore. But I saw some stuff passing by last week around teleperformance and the impact of large language models and open AI to their business effectively, because they are of course in the business of call centers and all of this. They do a lot of automation, but now with ChatGPT, yeah, that's of course a serious threat. And I thought that I recalled somewhere that one of the managers there, the board of directors, or maybe even the CEO, said like this could impact their business in the long run severely. But I can't find the quote anymore, so I don't know if this is indeed the truth. Also, how is it? Clarifying what's happening to teleperformance. You had also a second question that was about how to evaluate lower yielders with structural special dividends like AFG, ticker symbol AGCO, CME, and such. And I mean, it's really a tricky question, because with special dividends, I think the company is still saying like, guys, you cannot count on this dividends. And here comes the question, right? Do you need to count on those dividends in times of a crisis or not? I say typically yes. So I don't really want those kinds of stocks in my portfolio where the dividend can be cut. So in that case, I would look at the real dividend and treat the the special dividends as an addition. And I've got two of such stocks in my portfolio, BHP and Rio Tinto. They often do this as well. And I don't count on those dividends. I even in my portfolio tracker, I of course capture the dividend payments, but I don't put them in my dividend yield as an example calculation. I exclude them from there.
Yeah, I'm the same. Of the tickers he's listed, I only really know CME Group, and I know that they are quite consistent with special dividends. But you're right, they might not always be. I think they call it a special dividend for that reason. They know that there might be a time when they will not be able to pay this, or that they can't afford to pay it, and they'll revert back to their base dividend. So I look at base dividend first. CME actually have a quite a decent starting yield. I think it's 2.6% in around that. The rest of the companies he's listed, I've looked at, they've all been sub 1%. But I would analyze them from, as you said, their normal dividend, and treat that as a nice little bonus that you're not expecting at the end of the year.
Exactly. It might buy a bottle of champagne.
Exactly.
Yes.
Marco has asked us top 3 stocks on your watch list currently for potential next buys.
To be honest, nothing. I've been 2 weeks out, and I need to do my homework. The time I spent since yesterday was more in preparation of the podcast. So I have honestly totally no clue what to buy. I really need to look at my watch list in general, where I've got my 40 stocks that I would like to have. I need to check like where are they at the moment of the yield, how have they been doing. So I have no clue, Marco, at the moment. Sorry.
I'm looking at expanding my portfolio with British American Tobacco, increasing that size to around 100 odd shares. Vici Properties, which I've spoke about a couple of times, is high on my list. And also on my list is a fund, these closed-end funds that we can buy over here in the UK, called TR Property. And what I like about them is, I've never spoke about them before, but they invest in pan-European, so European property. So Vonovia will be a small part of their portfolio, for example, but not just Vonovia. And they're also very UK dependent as well. So there's a lot of UK property. So it gives me wide access to property in Europe without having to understand the markets, because that's my biggest complaint. I have a fund manager to do that for me, and they have a nice starting yield of about 3 or 4% as well.
Nice one.
UK dividend growth. In your opinion, does Apple have a place to be part of a dividend growth portfolio?
Well, we spoke about it. I think at the current share price, I would just look further and avoid it. I mean, I had the luck to buy them at a really good price, in my opinion, at the time, and it was then trading at a 13 PE. So I think even at the yield at that time of 2.5 or 2.7%. I mean, that's not what you're getting right now. So for me, does it have a place to be part of DGI portfolio? Generally saying yes, but at this moment in time, please, no.
Yeah, the yield is too low, but the question is dividend growth, not dividend yield. So technically speaking, it does, but
Yeah,
not at these prices.
but the dividend growth, think about DGI portfolio, the growth is not even helping you. I mean, you will need to sit 40 years before you get something meaningful out of it. Yeah, at this valuation and growth numbers. So, I mean, yeah, it is a dividend growth stock, saying like that, but I think price does matter, your anti-price.
Casper has asked us our opinions on CVS, currently at a 52-week low. Is it a value trap like Walgreens? I mean, so long ago, everybody was ranting and raving about CVS. I know they've increased their dividend for the first time in a couple of years. They've got their debt under control. They certainly seem like a better managed company than Walgreens, and our good friend Dividend Wave definitely would pick CVS over Walgreens. Whether they're a value trap or not, look, I don't know. It's hard to know, but we do know that there's only two companies in the United States that do what they do, and it's both CVS and Walgreens. But I'm not looking at them. I'm kind of leaving Walgreens to the wayside as well. I know that they've dropped in share price. I'm not adding to them. I'm not selling to them. I'm getting a good yield from them, and I don't expect that dividend to be cut. So I'm not entering a position in any of them now. So I don't know. It's hard to know without me actually going back in and looking at them completely. But as I said, I do know there's only two companies do what they do, and it's CVS and Walgreens. So I think it's good to own one of them. Casper
Nice.
also asked me, did I see any food line stores? And actually, I was not paying attention. I did not, but I did a Google Maps just now to see my area if there was any, and there is loads of them. So I must have had my eyes closed. But I'm going back over, as I said, in 2 weeks' time. I will definitely take more note and take a picture of Food Line. I might even go in and support the business too.
Nice one. Nice.
Centrino, about Chesnara, what would be a nice price to open a position?
Yes. First of all, it's really hard to answer that question. But let's say like that. I would look at a company like Chesnara, and maybe for the listeners, Chesnara is an insurer, a small cap in the UK. I own some shares in that, and I think you might have seen it, Centrino, based on the 20 UK dividend stocks list that I totally refreshed. I said over the last few weeks, and I did a republishing of that one, and Chesnara is also in there as a high yield pick. I would look at this typically as because how they deal, right? They work with they buy portfolios from other insurance that are kind of closed book. So it's just like kind of these portfolios, they still have insurance packages in, call them cigar butts. Yeah. And because Chesnara itself was a spin-off like many years ago, they can't really be competitive in the UK as easily as that because of the conditions at the time. But now they are also growing. I said investing and acquiring, for instance, companies in the Netherlands and Sweden that have actually an open policy, so where they can also acquire new customers. So that's how they earn their money, which means that this company needs to be excellent in acquiring portfolios from cigar butt portfolios to continue growing their value, let's say their asset value as a company. So these companies are a bit harder to value because you cannot look at earnings per share. You cannot easily look at cash flow, but you really need to look at more kind of their net asset value. Let's say something like that. So how I value such a company is with the dividend discount model, and also with the thinking about the chowder rule. So in this case, if you know that the average dividend growth is 3% over the last 5 years, and again they just hiked their dividend also with 3%, I would just look at the starting yield of 9%. Now, currently it's yielding 8.3% at a share price of £2.79. So I think in this case, Centrino, I would just look for a 9% entry yield position here, knowing that it grows with 3% and you're meeting your Chowder rule of 12. That's how I look at it. Again, it's not an investing advice. These kinds of companies are really hard to value as such. For me, they also deserve only a really small place in my portfolio, and I got already a full position with this one.
They're pretty much yield plays, these ones. I think it's
Yeah, it's a yield play, but with what is it, 18 years or something like that, consecutive dividend growth. And they see themselves as a company where the dividend is kind of one of the most important one as their reasons of existence.
Snowblind has asked us our feelings on Kenvue. I think we've kind of gave that earlier. I'm selling. I know you're selling as well. Prabhu has asked us a question on dividend withholding tax. Let's say residence country has a 20% tax on dividends. If one gets dividends from Irish stocks, which gives you a 25% tax deducted at source, how is it taxed at the investor's hand? Do they have to pay another 20% tax to be paid to the local government?
No. Okay. So first of all, I'm not a tax advisor, and it might differ per countries. So I'm speaking here in general terms, but you need to double check it. So your answer is typically in the in the tax treaty between your country where you are a resident, a tax resident, and in this case Ireland. And mostly there, because of the OECD rules and the international agreement, there should be something in there that says that not more than 15% or something like that may be taxed. In other words, what it means, if this is in the tax treaty between your resident country and Ireland, it means that if you pay 25% tax in Ireland and it's withheld there already, you can claim back 10%. Yeah, and this claiming back is really hard because of the requirements that the tax officers have and our brokers how they screw us. It's really criminal. But so you have right on those 10%. Then when it comes to your 20% that you need to pay to your local government, no, usually you give up that you paid already 15% in the other country, not your 25%, but 15%, and then you still need to transfer 5% to your local tax office by the end of the year, which means that if you buy an Irish stock, in your case, you pay in the end 30% in dividend tax if you don't reclaim back the 10% from Ireland.
Yeah.
And this reality actually for most European investors that deal with these kinds of inter-country
we really need a pan-European policy. We really do.
They are working on it, but it goes so slow. It goes so slow. I think we will quicker discover alien life somewhere than that we get in Europe and consolidate dividend tax policy and access.
I know you say claiming back the dividend tax can be difficult. One thing I will give Ireland credit for is how easy it is. Well, for me as a resident, how easy it is to go in and file and actually claim back tax. I assume it's similar for outside.
Well, it depends because, for instance, some countries they really want to see a tax voucher, and if you are at Interactive Brokers, you pay like I don't know, is it a German tax voucher, I believe, or French? One of those you pay €30 per line item, and if you only get €10 in dividends, it's not even worth to ask for it. And this is what I mean; it's criminal because the whole reason for this is that the shares are actually again not yours, so that needs to go, I think, via a clearinghouse and everything. I mean, it really feels like shady, all of this stuff, when we go into the world of the brokers, right?
Yeah. And a second question from Prabhu is stocks can be bought on different exchanges. For example, Unilever can be bought on the London Stock Exchange, New York Stock Exchange, and the Amsterdam Stock Exchange. Is it better to buy in resident currency or does it matter where one buys?
Yeah, so we're talking here also again about optimization, right? And there are a few philosophies. So I think if you don't want to have currency impact directly and don't pay fees for currency and such, you could argue like if you're in a euro country, buy the shares also in euros, right? There are two catches to that. One is liquidity. If you buy, for instance, certain American shares in euros, there might be limited liquidity there as well. And secondly, I don't know what it is, but I have my own preference to buy shares at their local stock exchange. And probably it is also due to liquidity and such.
Yeah.
So that's usually my approach to investing. And if that means currency impact, yeah, it means currency impact.
Yeah, sometimes I prefer to buy on the euro, just like to keep it. It's easier to track, but I mean, I don't know. Sometimes I don't think about it. For example, I own British American Tobacco on both New York Stock Exchange and also on the London Stock Exchange. I think in the beginning I bought BTI, and then on Interactive Brokers I bought them on the London Stock Exchange. So, I mean, I don't think it matters a whole lot. I mean, liquidity in all these will be quite high.
Yeah, and the tax doesn't differ.
No.
Yeah, it's the same with CRH ticker symbol. Yeah, the cement company and DCC on the London Stock Exchange. You could think like, oh, nice, 0% tax, but no, you still pay the Irish dividend tax there. So
exactly. Okay, a nice question from MH79. What are your general learnings from the recent quarterly earning reports? Are there any insights that influence your investment strategy for the coming months?
I mean, nothing new as such, but if you look at the reports today, it's like quality pays off. The quality companies have usually a tailwind, which is stronger than an economic cycle. And that's what we see, for instance, now with Microsoft. Yeah, it is just breaking all of this, and that's usually also so difficult because it's really hard to get those companies at a reasonable price.
Yeah. Well, what I found interesting was before we came into this slump, inflation was starting to pop up in a lot of reports, and I think we mentioned it before it even became a thing. Inflation was been mentioned quite a bit. I'm not seeing that as much on reports now, even though we're in the middle of an inflation period. I'm not reading it on reports as much. They're not for want of a better word, they're not blaming inflation for different things. So everything seems to look a little bit more positive, which is quite encouraging as well, I have to say. And also from a tech point of view, AI is just being mentioned at every single opportunity.
Yeah, it's a bit annoying.
Yeah, so I mean, but it does tell you something. But I just think it is interesting that the inflation has gone away. We might just start to see that now come down over the coming months.
Yeah.
And we might be in a better position. But for me, everything seems a little bit more positive than I was expecting, I have to say. I don't think I've read one report, both for Sure Dividend that I'm writing for and the couple that I've analyzed that has had a particularly bad report, apart from TROW price, which was negative. But
yeah, or the semiconductors, right?
Yeah, I actually haven't read any of them, so maybe that's why.
Yeah, but what you mentioned about inflation, I read somewhere, and I don't know if it's in the Netherlands, that they don't expect to get back to a 2% inflation by 2025 or something like that. So they still expect higher rates of inflation in the upcoming years. I just think that companies are a bit more used to navigating this now. I saw a lot about currency headwinds, everywhere, because of course the euro strengthened a little bit again compared to the dollar from, let's say, parity to 111 now. So that means for many American companies like a 10% drop in their euro earnings.
Yeah.
And that's what you saw also in Microsoft, right? Like 9% revenue growth or 13% after currency impact. So yeah.
MB has asked us the best stocks to buy right now. I don't know, but I gave my 3 that I'm on my watch list earlier: VG, British American Tobacco, and TR Properties. Tim has asked us, what's the weirdest place you check for brand names? For example, I always check door locks for the brand name now, as he is an AAPL investor.
So the first moment I step somewhere in public transport, like a train or a tram, where I've not been yet, I'm checking if it's from Siemens.
Nice. I don't really have that. I just take in all of them. Like I was on an escalator the other day, and it's Kone. And my sister was there, said, "Oh, look, there's Kone," and she's looking at me like I have 10 heads. And trying to explain to her. I think it's just habit now. Anywhere that you see, it was actually pretty unique when you were in America. You get a sense of what's the storage company? There's a storage company that everyone's talking about, and CubeSmart was there, and all these companies that people have spoke about that I've never seen, and I'm going, oh, look at this. It's quite interesting.
Yeah. So the one I still have it with is toothpaste. I'm often checking my toothpaste if it's because I don't always have the same. Then it's Colgate, then it's Aquafresh, and I always need to check. Okay, was this Procter & Gamble or Unilever? Because I don't want to have the ones from Procter & Gamble because I have Unilever shares.
Yeah, nice one. Okay, you have asked us the question, and that is, we're going to be 3 years doing this podcast soon, actually.
Yeah. So what are we going to do?
What are we going to do for? I don't know. We must have a little think about that, or if our listeners have any suggestions. I know we did a live show before. If that is interesting, just let us know and we'll see what we can do.
Exactly.
Flo has asked us, ever thought of Royalty Pharma? No, I haven't heard of them. Flo mentions that they have a nice business model. They diversify between the best pharma companies and medicines. I'm not really familiar with them, but I will put them on my Dividend talk stocks that I've never heard of, and will definitely look at them. So thanks for that. And then another question from Paul about Kenvue, which is obviously quite popular. Are you buying more Johnson & Johnson? Personally, I will buy more Johnson & Johnson and not Kenvue.
Yeah, same here. But we also need to know that the risk in Johnson & Johnson is increasing because it's now way more dependent on the drug pipeline, specifically because medtech is not so strong growing as their drugs. So keep an eye on that, guys. The risk is increasing. So even though we're used to the trustworthy clockwork of 6% dividend yield, it really becomes now a big pharma company in the sense of biotech and that means more complexity in the business, more subject to patent cliffs. Just keep an eye on that, because this was not historically how we have learned to appreciate Johnson & Johnson.
Yeah, I'm not betting against their dividend hikes again. I've already lost once.
Yes, we need another reason to have a vodka shot on our podcast next time.
I'm sure we'll find one. Yeah, that's it. Thanks a million to all of our listeners for all the questions. Again, apologies we missed last week. We will try and make sure that is a once-off. And thanks to you, European DJ. It's been a pleasure having you again.
As always.
I mean,
likewise.
2 weeks is too long, so let's make sure that doesn't happen.
Yeah. Have a great weekend, everybody, and see you next time again.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.